Welcome back to the Daily Crypto Roundup, and today's episode is one of those days where the charts look ugly, the mood has flipped fast, and a lot of people are asking the same question at the same time. What on earth just happened to the market? Because this isn't one of those slow bleed days. This isn't a drift lower over weeks. This is sharp, aggressive downside, happening over hours, not days. And when moves like that happen in crypto, there is always a reason, usually more than one. And today is no different. What we're seeing right now is not a random sell-off, and it's not just crypto doing crypto things. This is a very real, very measurable risk-off event that started outside crypto and then slammed straight into it. And once it did, the structure of the crypto market made the move far worse than it needed to be. Let's start with the most important point first, because this sets the tone for everything else that follows. Crypto did not sell off in isolation today. Bitcoin didn't wake up and decide to dump on its own. Ethereum didn't suddenly lose its fundamentals in the last 6 hours. What happened is that global markets moved into risk-off mode, and crypto once again was treated as a high beta risk asset. We've had renewed uncertainty around US monetary policy, specifically around the future direction of the Federal Reserve. There's been fresh speculation, commentary, and positioning around who may lead the Fed going forward, and what that means for rates, liquidity, and balance sheet policy. Markets hate uncertainty more than bad news, and right now, the uncertainty is back. When traders begin to price in the possibility that rates stay higher for longer, or that liquidity won't ease as quickly as previously hoped, risk appetite dries up fast. You don't wait for confirmation in those environments. You cut first and ask questions later. That's exactly what we're seeing. Now here's where crypto makes everything worse. Once Bitcoin lost key technical levels, the sell-off stopped being discretionary and became mechanical. This is the part people often miss. A huge amount of the crypto market is leveraged. Futures, perpetuals, options, cross-margin accounts. When price moves through certain levels, forced selling kicks in automatically. Over the last 24 hours, but accelerating sharply in the last few, we've seen a cascade of liquidations. Long positions were wiped out, not because traders changed their minds, but because they were forced out by margin requirements. Those forced liquidations dump market sell orders straight onto the books, regardless of price, and that creates a feedback loop. Price drops, liquidations trigger, forced selling hits, price drops further, more liquidations trigger. This is why crypto moves don't look like traditional markets. They're fast, violent, and unforgiving. What's important to understand here is that this wasn't driven by a single piece of bad crypto-specific news. There was no protocol failure, no major hack, no sudden regulatory ban announced in the last hour. This was a macro-driven sell-off that crypto amplified because of its structure. Another key factor today has been positioning. The market was crowded. Too many people were leaning the same way. Open interest was elevated, sentiment had turned optimistic again, and funding rates were reflecting that. When markets are positioned one way, it doesn't take much to tip them the other way. Once the unwind starts, it doesn't stop where it should. It overshoots. That's what we're seeing now. We're also seeing institutional behavior shift in real time. Some of the demand that had been supporting the market over recent weeks has stepped back. That doesn't mean institutions are bearish long-term. It means they are managing risk. When volatility spikes and correlations go to 1, capital preservation becomes the priority. This is why you're seeing selling not just in smaller altcoins, but across majors as well. Bitcoin, Ethereum, and large caps are all getting hit, because this isn't about picking winners and losers today. It's about reducing exposure. And yes, ETFs and structured products matter here too. When flows slow or reverse, that removes a layer of support that the market had been leaning on. Again, not because the thesis is broken, but because short-term risk has changed. Another thing worth mentioning is timing. A lot of this move has happened during periods of thinner liquidity. When order books aren't deep, moves get exaggerated. Large orders move price more than they otherwise would. That's exactly what we've seen during parts of this sell-off. So when you zoom out and piece this together properly, the picture becomes much clearer. Global markets turned risk-off. Macro uncertainty re-entered the frame. Crypto, as a high beta asset, sold off. Key technical levels broke. Liquidations cascaded. Forced selling accelerated the move. Liquidity thinned. Price overshot to the downside. That's the sequence, not theory, not vibes. That's what actually happened. Now, the question everyone asks next is whether this changes the bigger picture. And the honest answer is no, not structurally. This kind of move feels horrible in the moment, especially if you're watching the charts tick by tick. But from a market perspective, this is what resets excess. This is what clears leverage. This is what shakes out weak positioning. Every major bull cycle in crypto has been built on moves like this. Sharp corrections, violent flushes, moments where sentiment flips from greed to fear in hours, not weeks. You don't get sustained upside without these periods of pain in between. That doesn't mean price can't go lower in the short term. It can. Markets don't owe anyone a bounce on demand. But what it does mean is that this move has a clear explanation, clear drivers, and clear mechanics behind it. This isn't random. This isn't the market dying. This is risk being repriced. For long-term participants, days like today are uncomfortable, but they're also informative. You learn where real demand sits. You learn where forced selling ends. You learn how the market reacts under stress. And for anyone newer to crypto, this is one of those moments that teaches you more in a few hours than weeks of green candles ever could. Because crypto doesn't make people rich by going straight up. It does it by testing conviction, patience, and discipline when things look the worst. This isn't the end of crypto. It's not the start of a straight line down either. It's a market doing what markets do when leverage builds up and macro conditions shift. So as ugly as today looks on the screen, it's important to separate emotion from structure. The move has reasons. The reasons are visible. And once this forced selling phase runs its course, the market will stabilize again, just like it always has. That's where we'll leave it for today. Drop your thoughts in the comments, let us know how you're reading today's move, and as always, we will see you at the top.